You open your brokerage app, stare at a stock, and watch the price flicker. Up a cent, down 3 cents, up again, and you're sitting there thinking, who's doing that? Is there some guy on Wall Street just typing in numbers? Some algorithm deciding Apple is worth exactly $213.47 today and not a penny more? Here's what's wild. That price you're looking at, it's just the result of the last trade. One transaction between one buyer and one seller. And that single deal, maybe 100 shares worth a few $1,000s, technically sets the value of a company worth trillions. That's the system. And once you understand how it actually works, you'll never look at a stock price the same way again. Part 1. The order book. The thing nobody shows you. Let's start with the actual mechanics. How does a stock price physically change every second? Every stock exchange runs on something called an order book. Think of it like a live auction sheet, constantly updating, showing every single person who wants to buy a stock and at what price, and every person who wants to sell and at what price. The buyer's prices are called bids. The seller's prices are called asks. And the gap between the highest bid and the lowest ask is called the spread. Here's where it gets interesting. When you look up a stock price on your phone right now, that number isn't necessarily what you'd pay if you tried to buy it. It's just the price of the last completed trade. The real price you'd get depends on what's sitting in that order book at that exact moment. Let me show you exactly how this works with a real example. Say Apple is showing a price of $210. The highest bid in the order book is $209.99. The lowest ask is $210.01. That 2-cent gap? That's the spread. The moment a buyer agrees to pay $210.01, a trade happens. That becomes the new price. Then it moves again. This is happening thousands of times per second, not because of some conspiracy, because millions of people and machines are placing orders constantly. Now, here's what nobody talks about. That spread? It's not free. It's a hidden cost that quietly drains money from every single trade you make. For a massive stock like Apple, the spread is about 1 penny. Sounds harmless. But for smaller, less traded stocks, that spread can be 10, 20, even 50 cents. If you're buying a stock at $3 and the spread is 30 cents, you're already down 10% before the price moves a single inch. That's not a typo. 10% gone before anything happens. Part 2. Who's actually setting these prices? Here's the part that'll make you raise an eyebrow. The firms that make money every time you trade, called market makers, handle the vast majority of all retail stock orders in America. These are companies like Citadel Securities, which processes roughly $35 billion in equity trades every single day. One firm, $35 billion daily. And here's how free trading actually works. When you use Robinhood or any commission-free broker, your order doesn't go directly to the stock exchange. It gets sold to one of these market makers. The broker gets paid, the market maker earns the spread. You get a price that might be a fraction worse than the best available. It's called payment for order flow. And in 2021, U.S. brokers collected $3.8 billion from it. Think about it this way. You walk into a store expecting everything to be free, but the store is quietly selling your purchase data to the highest bidder and adjusting the prices ever so slightly in their favor. That's essentially what's happening. Is it illegal? No. Is it something most people have no idea about? Absolutely. Part 3. What actually makes prices move? Okay, so now you know how prices change mechanically, but why do they surge or crash? 3 big drivers: earnings, interest rates, and pure human emotion. Let's break each one down. Earnings are the most powerful scheduled force in the market. Every quarter, public companies report how much money they made. Miss the number, even slightly, and the market punishes fast. On February 3, 2022, Meta reported that its daily active users had declined for the first time ever. The stock dropped 26.4% in a single day, erasing over $230 billion in market value in one day. And here's the brutal part. Algorithms had already processed that report and started selling within 5 milliseconds of the announcement. By the time any human read a headline, that was done. Interest rates are trickier to explain, but the concept is simple. When interest rates rise, safer investments like bonds start paying more. So investors demand a bigger return from stocks to justify the extra risk. The way they get that? They pay less for stocks today. A 1% shift in interest rates can swing a growth stock's calculated value by 10 to 20%. That's why when the Fed raised rates from near zero all the way to 5.5% between 2020 and 2024, tech stocks got absolutely hammered. The math changed. And then there's sentiment. This is where things get really messed up. In May 2020, Elon Musk tweeted that Tesla's stock price was too high. Tesla dropped 10% within hours. He sent one tweet. Billions of dollars evaporated. Same year, he tweeted, "Use Signal," meaning the encrypted messaging app. The problem? A completely unrelated company called Signal Advance had a similar name. That company's stock went up 1,500% in 24 hours. The company had nothing to do with Musk, nothing to do with messaging apps, and its market cap went from $7 million to $100 million on pure herd mentality buying. That's not investing. That's a stampede. Part 4. What's a stock actually worth? Here's the uncomfortable reality most financial media won't tell you straight. Nobody actually knows. There are formulas. Smart people use them, but they're estimates built on assumptions, and different assumptions give you wildly different answers. The most common method is called discounted cash flow, or DCF. The idea is simple. Figure out how much money a company will generate in the future, then work out what that future money is worth today. $1 10 years from now isn't worth $1 today because of inflation and opportunity cost. Here's a quick example. Say a company generates $100 in cash profit every year for 5 years. Using a 10% discount rate, which accounts for risk and inflation, those future cash flows are worth roughly $379 today, not $500. Add the terminal value, which is what the business is worth beyond year 5, and you get your total estimate. Simple in theory. The math is fascinating, but here's the problem. That terminal value, it makes up somewhere between 60 and 80% of the total estimate. So the whole valuation is basically a function of what you assume happens years from now. Change one assumption, growth rate, discount rate, market size, and your output changes dramatically. Take Tesla. Analysts have calculated Tesla's fair intrinsic value at somewhere around $130 to $165 per share using DCF. Meanwhile, the market has priced it well above $300 for most of the last 2 years. That doesn't mean the market is wrong. It means investors aren't just pricing what Tesla earns today, they're pricing what they believe it could become: an AI company, a robotics company, an energy company. They're buying a story about the future, and sometimes those stories pay off. Sometimes they collapse. That's the game. Part 5. The psychology problem. Your brain is actively working against you. Let me be real with you for a second. Even if you understand everything we've covered so far, the order book, the spread, earnings, valuations, your brain will still try to destroy your returns. Here's why. Humans experience losses roughly twice as intensely as equivalent gains. This isn't philosophy, it's neuroscience, established by the research of Kahneman and Tversky. Losing $500 feels about as bad as winning $1,000 feels good. That asymmetry causes something called the disposition effect. Investors tend to sell their winning stocks too early and hold their losing stocks too long. The stocks they sold went on to outperform the ones they kept by over 3 percentage points in one major study. And here's what nobody talks about. The most active traders consistently underperform the most inactive ones. Research tracking over 66,000 household accounts found that investors who traded the most underperformed the market by 6.5 percentage points per year. 6.5 points. Compounded over 20 years, that's the difference between $100,000 growing to $345,000 or to $717,000. The math is brutal. And then there's timing. JP Morgan's data across a 20-year period shows that if you'd invested $10,000 in the S&P 500 and just left it alone, you'd have ended up with roughly $64,800. If you'd tried to be clever and missed just the 10 best trading days, 10 days out of 7,300, you'd have ended up with $29,700. 7 of those 10 best days happened during bear markets. 6 of them happened within 2 weeks of the 10 worst days. The people who panic and sell during crashes are almost guaranteed to miss the bounce. So, there you have it. But make sure to subscribe if you want more videos like this.